everybody. So yeah, we
Take it
do
easy.
have some topics here we're going to talk about: a little AI, a little CFPB, some MI conversations, and some loan level price adjustments that hopefully we can see improvement on. But first things first, I think everybody understands or uses or at least have heard of ChatGPT. There was one that came out of China, DeepSeek, that they did an audit or basically released how much it cost them to create their AI, which came to the tune of $6 million, where ChatGPT, which a lot of people use, was well over $100 million. This threw our stock market into a free-for-all sale, and most importantly, led by NVIDIA, lost just a ton of money. Now I'm looking at their stock prices now; they have came back, but normally in the mortgage market, when people are looking at interest rates, if the stock market's doing bad, it normally moves money into bonds. And if more bonds are being purchased, interest rates get better. So we saw a good day there, but it was something that kind of shocked everybody that, this other technology comes in for fractions of the cost and really just upset like how everything was going. So I don't know if you've played around with DeepSeek. I don't know if you play around with any AI tools, but do you have any thoughts on what this what this huge ripple did, on January 27th?
Me?
Yeah.
Oh, well, don't. Whoever said crime doesn't pay didn't know what they were talking about and never talked about stealing code from country to country. It's really pretty simple here. This isn't too far to walk to figure this one out. When you steal code um, from American companies, and we have intellectual um, code that is taken from one country to another, you don't need to spend $100 million to develop that code in order to release a cheap knockoff. I saw this uh, I saw on one of these feeds, Reddit or, TikTok or Twitter or Facebook or one of the million things that we waste all of our time with. But they actually bought a Jeep Cherokee from China, like a knockoff Jeep Cherokee. And
Mhm.
it was a Jeep Cherokee. It came out of the box. They got it for $4,000, brand new 2025 Jeep Cherokee. The wheels were half the size. The paneling wasn't very good. The stitching was falling apart immediately, but you got a Jeep Cherokee. And that's what's taking place here. The truth of the matter is DeepSeek is fantastic.
Mhm.
What is there intellectual theft that took place in order to get it? That's the only way you can rationalize what the prices are. Since then, we've also heard that Google is coming out with a new AI, Facebook's coming out with a new AI, Twitter's coming out with one, and they're supposed to be faster than the DeepSeek that was just dropped, where they had, the source code is free for anybody to go ahead and use and manipulate. Yeah, I'll tell you what I think's happening here. I think that was a big old FU from the Chinese by dropping that because of everything that's taken place with TikTok over the past, month and a half to 2 months pre and post the election. Who's going to own TikTok? Now you can't get TikTok and the money that's associated with this. And then the Chinese come out and drop DeepSeek and say, bang, we are 9 moves ahead of you. Oh, TikTok, we don't care about that. Slam. Let's throw your stock market in disarray. Let's put everybody in panic mode. Let's make something 10 times faster and take the source code and give it away for anybody to use for whatever they want. And yeah, it was crazy. Not in the circles we run in, but if you start looking at the Silicon Valley and some of the intellectual hubs in this country, this was a big deal. This is huge.
Mhm.
Um, so there's now a salvo that's gone back across the net with what our companies are going to be doing, and this is just the new reality of the world that we live in. As it pertains to our industry, I think there's a number of different ways that we can look at this. In the mortgage space, let me see if I have this here. In the mortgage space, what we've seen is we have these just automated underwriting algorithms that are put together um, using artificial intelligence, and it's kind of like the first generation hair plugs. Remember those back in the 1980s? When guys would get these hair replacement surgeries, and as Bill Burr said, these guys would come and look like they had little ant legs sticking out of their forehead. It's like, oh yeah, your hair looks really normal. you know, Remember the first generation hair plugs, and have you seen the
Mhm.
latest generation hair plugs or any type of cosmetic surgery? It's gotten so much better over the past 10, 20 years. And we've been able to see this stuff as it's evolved on other people's heads. It's the same thing in our industry to a lesser visible extent. The first couple of generations of AI aided underwriting has been anything but perfect. Most folks who've gotten into this arena early on, they're the early adopters of it, have not found it smooth. Of course, it's going to get better. Of course, it's going to make getting our loans approved a hell of a lot easier. Running down programs, it's going to get easier. Right now, I'll tell you what, as a loan officer or even a real estate agent, if you want to become versed in the language of non-QM mortgages, for which you should be doing, a lot of potential clients and a lot of folks that you hang out with on a regular basis, um, they're the small mom and pop businesses in the communities that you work. These are places that you frequent, all the time. Those folks need loans too, and those folks want to move into houses. A lot of those folks who were there want second homes, third homes. There's great opportunities there, and they are going to live in the non-qualified mortgage space. Now, here's the cool thing with DeepSeek or other AIs. You can go in there and just type in, teach me about non-QM loans, and it will pull it up. And it gives you remarkable detail. I was shocked at the amount of detail that you got. Tell me how to get a loan for a self-employed person. From a loan, if you know more than that, from a loan officer's perspective, you can start putting in, the different bank statement loans. What conditions will I need to fulfill for bank statement loans? And it will give you the hit list of items you'll need to get. It will tell you for asset depreciation type of loans where you might have a significant amount of money that you're not necessarily going to use, and you can go ahead and depreciate that asset and you can extrapolate an income from it. It will actually show you how to do it. So
Mm,
immediately for realtors and lenders, I think what we're seeing from the DeepSeeks of the world and ChatGPT, and it's only going to get significantly better, and the curve is going to go up. It's going to be a compound effect in terms of how great this stuff gets. But immediately understanding a lot of the programs that are available to us, that's at your fingertips right now. And it will make the conversations that you will probably be having this upcoming weekend with people that you'll bump across that much more meaningful and opportunistic for chances to get these people to work with you. Is it going to be a replacement for real estate agents? I don't, I don't know. I want to read to you something I got from one of my good friends who I'll be doing an interview with here, either later on today or Monday for my show, Mortgage Shots. But his name is John Rincone. He said, NAR's recent settlement, the traditional free fee structures are on their way out. The future of real estate looks like this. It's going to be powered by artificial intelligence, AI. Not the AI that we have today, but AI going forward. He says transparent and straightforward, fee from hefty fees. The established players are losing their grip right now. While many may see the impending crisis, history shows that the toughest times often give rise to innovative companies. Significant changes pave the way for remarkable opportunities. Real estate is transitioning from high fee to zero fee, hidden charges to transparent pricing, dependence on intermediate to tech-driven solutions. For the first time, we have a chance to eliminate real estate fees entirely, not just reduce them. This is a game changer. Think about it. Why should you pay 6% in fees to purchase a home? Why hand over thousands of dollars to middlemen? Why spend the extra $24,000 unnecessarily? The clear answer is you shouldn't. What are your thoughts on these shifts? Now, I read this to you understanding who my audience is. I read this to you because this was posted today and it's already got 4,400 shares in a small community, which means it has wheels. And there's a lot of people that
mhm,
think this way. And if you're in real estate, we don't need to have our head in the sand. We want to know how we're perceived in the industry. And is there any truth in what Jeff said or Josh said here? Well, there certainly is truth in that. If that many people feel it, there certainly is something going on. There's a breakdown in communication from the value that's being given and the value that's being received for some folks. Um, but when it comes down to the third point that he made, is that dependencies on intermediaries to tech-driven solutions. The biggest thing that AI is never going to be able to do, and is a hugest asset for real estate agents, is the personal nature of a transaction. It is impossible to replicate that in any form of AI, and we put so little emphasis on the importance of the personal connection on a real estate transaction. I can go ahead and very easily put this in terms of numbers, and if the transaction is nothing but mere numbers, well, then of course AI is going to kick their ass. They're going to kick my ass too. They're going to kick everybody's ass. But we are empathetic, thoughtful, emotional beings. Humans are on varieties of scales. And when you're dealing with homes, which certainly are an asset, but those homes are also people have a wild personal connection to their homes. And when there's a process of buying and selling homes, particularly primary residence and maybe even investment properties for those who are not institutional investors, I would argue, and I would love to have a conversation with anybody about this, that the personal component of that transaction is as important, if not important, than the rate the person is getting on that deal or the deal that was or the contract that was negotiated. And I can prove it to you. If you've ever been a lender and you screwed up a deal. And I know, Shawn, we've never screwed up a deal, right? We have
Yeah, never,
never, ever,
never.
in 30 years of writing loans, I've never had a deal go sideways. Never, ever, ever happened.
Mhm.
When that deal goes sideways and you've got people who are crying and your realtors are pissed and everything is wrong, and you go to that seller or you go to that buyer and say, would you have taken an eighth higher in rate where your payment would change by $7 to have avoided the last 2 weeks with your family? There has never been a client in the world who wouldn't say, yeah, give me the worst deal for the better personal emotional experience. That's a fact, Jack. And it's a huge component, and real estate agents need to understand what their value is going forward because there are going to be many more posts put out that I just read that are going to take aim at you. And I will tell you this, and I'm going on here, but I'll tell you this. They are going to come from those who mean you harm. It's kind of like the person who ran that the lawsuit against the real estate agents in Missouri. He
Mhm.
came out with a text-based alternative to real estate agents a month after that thing closed. Well, ain't that convenient? And so when you are going to start to see assaults on real estate agents and what the value proposition that they're bringing to the table, and those that are going to be bringing these assaults against them, that are rationalizing the AI, are going to have tech-driven solutions that are simply going to take that money from transactions and they're going to point them in the direction of the AI companies as a cheaper, better alternative. And as we already know from the Open Doors, the OfferPads, the Zillows of years past, that the cheaper, faster alternatives tend to cost people more money in the long run, and you'd lose that personal connection.
Yeah, yeah. Very well stated. Let's switch gears here a little bit. There's been a lot of conversations or a lot of news about the CFPB. Love them, hate them. We weren't the greatest fans. We understand that there needed to be some oversight, especially from the Wild Wild West days from 2008 through 10. But they had, in my eyes, they had a little bit of a reach. They ruled with an iron fist, and they didn't really have to answer to anybody. And all of the rules, a lot of them were up for interpretation. So you're like, I don't know what they mean here, and then they really didn't give great guidance. But anyway, Trump comes in, new administration. Rit Copra, I think that's what his name was. He was the CFPB director from 2021. He was just let go a couple weeks ago via email saying, "Hey, thanks for your service. You're no longer needed here." Now, there's been some other nominees coming in. Scott Bessent comes in, and he was the acting director for a minute, and basically said, "Okay, everyone, turn off your computers and shut everything down. No more laws, no more lawsuits, no more whatever, and let's just pump the brakes for a second and let's take a look at what's going on here." Now, the ABA, the American Bankers Association, was actually really happy with this decision. As they state, they've been vocal about disagreeing with many actions the Bureau has taken in recent years that they say have exceeded its statutory authority, harmed our economy, and posed significant costs to the American people. Now, I am one to agree with the added costs because whenever CFPB comes around, everybody that's writing mortgages, handing out money, uh, they have to take on a lot more, a lot more legal counsel and a lot more disclosures, basically just a lot more hands on making sure that nobody is doing any harm, which comes with a lot more costs. And I think and correct me if I'm wrong, but I think the stat that they put out is that on average, it's like $13,000 for one mortgage to be originated from everything that's associated with giving somebody a mortgage these days. So I don't know and then now there's a new nominee, Jonathan McKernan, who was the previous member of the FDIC board that's supposed to be up for nomination to take over the CFPB. What what are your thoughts, one, on the CFPB's state where they're currently at, and what do you think might happen going in the future? Because some saying, "Oh, just get rid of them, no need," but then you don't want the wild, wild west days back whenever people were doing some really, really weird loans and doing some shady stuff. I'll let you take it away with your thoughts.
My in-laws are pack rats. My wife's parents, pack rats, just pack rats. They never met anything they didn't like. They collect everything. So they moved from a big house when they got older to a smaller house. They took
Mhm.
they got two storage units, the big ones where you could park cars in them, but they didn't park cars in them. They parked their crap in them. Stuff I would otherwise throw away crap, right? Just packed them. Two of these things packed them full, right? One of them burned down. You want to know what happened? Nothing. They didn't even know it was in there. They had so much crap. They've lost a whole storage. They didn't even know it was in there. There's nothing to claim. They didn't know, but yet it meant so much to them to have that stuff. For all of those years, it meant so much. The CFPB just burned down, by the way. What's going to happen in the mortgage space? Nothing. It's the same thing as that storage shed. And 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 that's the best and most realistic analogy that I can give you because there are no less than seven other regulatory agencies that have oversight on mortgage lending and real estate. Why do we need another one? How many storage sheds do you need? You know, redundancy and waste in government is so rampant and out of control that it's just ridiculous. What we don't do is we don't correct a situation, we add to it. All right, if this isn't the answer, then let's take a bad idea and add to that idea. And as a result of this, we've got the Office of the Comptroller of the Currency, the FDIC, the Treasury, the Department of Justice, your state's attorneys general, HUD, Fannie Mae, Freddie Mac, the FHFA, and I'm missing a half a dozen of them. I mean,
Bureau of Finance.
it's ridiculous how many agencies we have. What's another one going to do? But this is a knee jerk to what turned out to be a bad time in mortgage lending when these other agencies weren't doing their job. I'm gonna give you something here real quick, and I just want you to listen to this. And I'm gonna be reporting on this one as well. According to an Inspector General report last year, HUD could not account for spending at its two largest programs. It was the seventh straight year officials couldn't estimate the scope of incorrect payouts at internal divisions that accounted for 2/3 of the department's total expenditures. So an internal review of HUD, who has regulatory oversight, they have no clue what they did with 2/3 of their budget from last year. They can't account for 2/3 of their budget. Do you know what HUD's annual budget is? 20 billion? 50 billion? You mean you can't figure out where 30 billion dollars? And this is the person who's got regulatory oversight, and the CFPB is just another agency, just like HUD and just like all these other ones, except it's worse because the CFPB, unlike every other agency, is not on our congressional budget. They don't have 30 billion like HUD to lose. They can't do it because Congress doesn't give them any money. They are not a line item on our congressional budget, which by the way makes them unconstitutional. No, the CFPB is fully funded by the FDIC. Oh no, excuse me, by the Federal Reserve, who also has authority over as well. The Federal Reserve it has a blank check for the CFPB to spend money, and man, did they ever! When they started this thing, they were the highest paid civil servants of any agency anywhere in the country. And the first thing that Richard Cordray, our first acting director, did was he bought the most expensive building in DC, which was right next to the White House, so he can just walk on over to President Obama and I don't know, maybe throw a ball around on Sundays, watch a game and barbecue. I don't know. And then what he did after buying the most expensive building in DC is he refurbished it to the tune of over $100 million. They had a blank check. Now, if you think what HUD is doing, you think HUD's bad by losing 2/3 of their budget from last year? I don't know. If you think that's bad, give them no budget. Give them an unlimited budget. It's crazy. So, how the inception of the CFPB was a bad idea. It was done as a knee jerk, which was a bad idea. And truthfully, I think Shawn, why me and you dislike it is when they came out under the lead of Richard Cordray, It was a pound of flesh agency. They weren't going in there to right wrongs. They were going to get something back. They were going there to harm an industry that they feel or scapegoated that harmed the country. And they did this and they created overlays and redundancies and costs that are absolutely ridiculous. So yeah, I'm kind of glad they're gone. Now, the big thing is they have jurisdiction over RESPA, but they took that from HUD. You still are going to have if you're a real estate agent or a loan officer and you think your business is slow right now, so maybe it's a good time right now to blur lines. You don't want to blur lines. I said it on my show a couple of days ago. There was just a lawsuit in Pennsylvania, and it was basically about commingling money with real estate agents and loan officers. And it was brought from the state attorney general. It was not brought from the CFPB or HUD. So now is not the time. And truthfully, I think this is kind of a booster shot for the other agencies saying we got to pick our enforcement game up a little bit because the CFPB is not here. But them as an agency and the years they were around and some of the enforcement actions that they took just seemed like busy work to rationalize their existence in the first place outside of harm. So for me personally, we don't miss a beat. It's my in-laws storage unit. Burn it down. Nobody cares. You don't even know what's in there.
So what I'm hearing is I cannot give out computers to agents for leads still.
I would not do that. No, no, I would not.
That's a big no-no. Well, you hit on costs, and I know that's been a hot topic of trying to make it cheaper for builders to build houses, because of inventory and then also affordability. And, there's only so much money to go around, especially for people trying to get into this market. I think that we saw a stat that the average first-time home buyer is actually at the age of 38 years old, which I find
Yep.
crazy that you're almost damn near 40 and finally buying a house. But that's just the state that we're in with the inventory issues in a lot of the markets, just the cost of the house in a lot of the markets, and then also how much is the money cost to pay back whenever you're borrowing. So I know that there's a pretty big push, and that's going to move us right into our next topic is like FHA lending. FHA, I forget the fund. You're gonna educate me on this, but on an FHA deal, on if someone's buying a primary residence, putting 3.5% down, they're getting hit with an upfront mortgage insurance premium that goes into the kitty, and then they have a monthly MI cost that they pay that's on for the life of the loan if they're only putting 3.5% down. Now, I do believe that that fund is probably overfunded by 4 times. So there's a chest full of cash that they're sitting on. And this fund also is responsible for any losses like on HECMs, for your reverse mortgages and things like that. But ultimately, what I would love to see is that FHA or HUD rolls back what they're charging clients. Do you think that you're going to see an MI correction with or an adjustment on what an FHA borrower is going to be charged to use that financing?
It is broadly agreed upon by every advocacy group that FHA should bring down their MI costs. This has been going on for years. As I said before, last time I interviewed Dave Stevens before he passed away,
Mhm.
this was one of our topics of conversation, and he had mentioned that he said, "Mark my word, Brian, FHA premiums are going to come down." And he ran the FHA, so you think if anyone knew it, he would know it, and we haven't seen it. You're hearing it from the National Association of Realtors, the MBA, the credit unions. The National Association of Home Builders even came out with this one. Everybody has. It is agreed upon that they should, and they're not. Not only are they not doing it, they're doubling down on holding on to it. So they've just created where you're bundling underperforming and underperforming FHA loans. They're bundling these, packaging them, and they're selling them off, and they're getting out from underneath their obligation of paying out any type of fund or fee on these things should these underperforming notes foreclose on. So they're actually wiggling out of their responsibilities by selling off a lot of these notes and doing a bunch of shady deals that are kind of behind the scenes. And listen, I think this when everybody says that you need to be lowering and I think we talked about this, when everyone says you should be lowering your fee because you have over 5 times the congressional mandate, it's the MMI fund, the Mutual Mortgage Insurance Fund. Congress mandates that you keep that at 2.25% of whatever your pool of loans are that you're insuring. They're sitting at like 8%. It might even be higher than that now. Last I checked, it was almost 5%. It's well above or 5 times the amount that they need to have. It's an unprecedented amount of money that FHA is holding. In the history of FHA, and for the past 60 years they've been doing this, whenever their fund got too high, that money was returned back to people buying houses in the form of lower premiums. And that's why we've seen our FHA premiums go up and down and vacillate over the years. Now it's higher than it's ever been, and they're holding steady, and they're making deals behind the scenes to protect that money even more. The only thing I can take away from this is they have their internal forecasters, their economists who are looking at the housing market right now, and they see turbulence on the horizon. That's the only reason you'd hold on to this, because the acting director right now is going, I don't want a bailout on my watch. I don't want that on my resume because I won't be here forever. Uh, During the last one, 2008, they got down to 0.5%. They were 2% below, 1.75% or 2% below whatever their congressional mandate was. And it took years to recover from that, but they never took the bailout. Fannie and Freddie took the bailout when their fund from the GFE got too low. And they're still dealing with that today in the form of conservatorship, which would be another conversation we would probably talk about if we weren't running out of time. So
Mhm.
I'm thinking they're holding on to this because they see something on the horizons that we don't, in terms of the housing market, which could come in the form of something of a more significant correction than we're seeing right now. And I think there is a correction on the horizons right now because prices are too high and everybody knows it. And so, yes, they should lower them, to answer your question. Yes, that should take place. If it was going to take place, it would have taken place a year ago. So my thinking is that ship has already sailed. They're holding on to this money for a reason.
Okay. And another thing, in 2023, they came out and they changed what are called loan level price adjustments.
Yeah.
And it's all risk-based pricing. So if I have a lower score and I'm trying to finance more, my rate is going to be higher, or the cost for me to borrow money is going to be higher. But in 2023, they came in and just updated them, trying to give people with lower credit scores better, quote unquote, better deals on conventional lending. And to the tune, like, I'm going to just give you an example. On a $400,000 loan, if you had a 720 credit score and you were putting 15% down, after these changes took place, it would cost you $3,000 more to have the same rate than you would the day before these changes went in. And I'll pull up a chart just so we can go over it so I can kind of show,
Good.
because
I want you to pull this up because
visuals are better.
I'd like to explain something here. And while you're
Yeah.
pulling this up,
Yeah.
okay.
So
So
this chart here, what I'm looking at is if I have a 720 to 739 credit score, putting 15% down, my price that I could offer a client, let's just use round numbers. Say a par rate was at 6% one day, and then these changes go in. Now that 6%, I have to charge 3/4 of a point, which on a $400,000 deal comes at $3,000. That's coming out of their pocket. Or to negate that, they don't get the 6% anymore. They get a 6.25, 6.5, whatever that comes out to be. So it
okay,
just got so much more expensive for people
okay,
that pay their damn bills, which
okay.
is asinine.
All right, here's what you guys have to see. All right, this is nothing but a money grab, wrapped up to appear as if they're doing something to help underserved communities, oftentimes minority communities, and they're not. This is politics 101 right here. And I'm going to show it to you, and you'll understand this in a minute. This is, I'm promising you, this is the Consumer Protection Bureau. We're protecting you. Oh, your loans are going to cost more money. We're going to pay people out the wazoo, and we're going to buy all this. You're anything but consumer protection. Here it is. So these changes were made um, with the idea that you were going to help those who needed homes more and could ill afford them, underserved and oftentimes minority communities who find themselves, and we know this from um, the Census Bureau, who have historically lower credit scores and lower savings. So we're going to make it less expensive for underserved communities to go ahead and take advantage of pricing. So we're going to make your pricing better. Okay. Now, what we're going to do is in order to make as much money, we're going to make it worse for people with good credit. It's the robbing Peter to pay Paul. Now, I actually am kind of okay with that to a certain extent. We need to elevate everybody. If you got $10 million in the bank, you don't need Fannie's help. If you're dead broke and you're institutionally broke generation after generation, maybe we should help you. I get it. Okay. So now, if you see at the top, new versus old. Now, if the greener it gets, the better it gets, the pricing got from going from the old and to the new. Now, the redder it gets, the worse it got. Okay? So the worst of all is right in the middle with that dead red. That's somebody with a 720 to a 750 credit score, which happens to be the average credit score of everybody who gets a Fannie Freddie loan. And it is 80 to 85%, which happens to be the average loan to value of people who get Fannie and Freddie loans. In other words, the people who utilize this program the most just got ripped off. Their pricing got a lot worse. Now, the people who got the biggest advantage are the ones in the darkest green. So, Shawn, I'm going to ask you a question here. And I want to know this too. I want to know this. Every lender in the country wants to know this. Shawn, I have a client with a 620 credit score. No, 620 credit score. And I want to get 97% LTV pricing. What lender is going to do that?
I have not found any approved eligibles with that scenario, sir. So as
Really?
far as going Fannie Freddie,
Really?
that's a very, very difficult loan for them to take the risk on. So
Okay.
I'm not saying zero, but I'm saying 99.999% of those scenarios do not get an approval unless if they have a ton of assets somewhere.
So let me get this straight. Fannie and Freddie, who set the guidelines for the automated approvals you get, are going to decline this virtually 100% of the time. They know it's going to get declined. So they give the greatest price improvements to loans that they know they won't do in the first place. That doesn't make sense. Now, does it, Shawn?
I'm
You get
picking
where I'm
up your
coming?
sarcasm.
Yeah, you get where I'm coming from on this?
Yeah.
Like the dark greens, nobody's doing those loans. No one's getting close to them. Nobody is touching these loans. You're never going to fund these loans in the darkest green. In other words, they gave a benefit to a class of people who that benefit will never, ever, ever, ever see the light of day. Never. It's never going to happen. So what they did was they added costs for people who get loans, and they pretended to give that benefit to underserved communities on loans that they won't fund in the first place. This was nothing but a money grab.
Yes, I
Brutal.
agree.
I mean, just
Yeah,
brutal.
we were screaming from the mountaintops whenever this happened, but I mean, unfortunately, no change. I would love to see if this gets rolled back because again, with a higher interest rate market that we've been experiencing compared to years past, this will only help with people getting a better interest rate or help affordability and keep money in their pocket.
Well, I mean, love Trump or hate him, and there seems to be a whole bunch of people on both sides. He is a little unpredictable, and
Yep.
that unpredictability. Maybe we will see that drop. Honestly, I'm not joking about that. Maybe we will. Maybe he'll appoint somebody who would bring some sanity back to this. But something will happen. We know that for sure.
Yeah, in a perfect world going forward, for everybody that's still here with us in 2025, if the extra costs that were associated with the CFPB lesson would be amazing. FHA's MI goes down, that would be amazing. And then the LLPA's getting less, that would be amazing. That's all that's going to do is help people get into the pool of the American dream, which is called home ownership. So
Amen.
we can fix the inventory, fix the affordability. Voila, everyone's singing kumbaya, and we're helping a bunch of families get into homes and making a couple bucks while we do it.
And meanwhile, the set of loan docs went from Dr. Seuss to Tolstoy.
Well, sir, I appreciate your insight, your wisdom, and your wit. And we will definitely be back here again next month talking about whatever else comes up on the horizon.
Love it. Thank you so much, guys. I appreciate it.